My guest today is Kaido Veske, co-founder and managing partner of Livonia Partners, a private equity firm focused on founder-led businesses in Northern Europe. Since launching its first fund in 2015, Livonia has grown to roughly 200 million in assets under management, backing companies in the lower middle market where these companies are large enough to matter, but small enough to shape. Kaido's story is fascinating. He studied and worked in the US, then moved back to Europe to build a firm investing in businesses that would likely never show up on Sand Hill Road or Wall Street, but can still compound value in a big way. In this conversation, we get into how Livonia helps its portfolio companies grow, including one standout example, Thermory. When Livonia acquired the business, it was doing a bit over 20 million in revenue, and by the time they exited, it had grown to over 110 million in sales. This is an in-person episode. I hope you enjoy it and that you take a lot away from it. Let's get started. My guest today, Kaido Veske, co-founder and managing partner of Livonia Partners. Thanks a lot for coming to the podcast.
Thanks for having me.
Let's start with a bit of your background because it's very fascinating. We were discussing before your father runs a... by the way, we're recording this in Eastern Europe, in Tallinn, Estonia, and your father runs Estonia. And you've seen him building this business. So my first question is, why did you even decide to launch your own fund instead of going to the banking industry?
Yeah, I think it's hard to say how much one inherits the entrepreneurship gene. I think in many ways it just happened. I was working and pursuing a career in the US. Then I did a business school in Europe, and then mostly I just saw a gap in the sort of Eastern European private equity, and I just went for it and never really looked back. That's where the idea was born, and I still helped my father create the bank, but soon after I think we realized that we are probably personality types were a little bit different. He was more focused on making today perfect, really making sure that today was perfect, and I'm probably of the type that cares more about that tomorrow is perfect, if that makes sense.
Mm-hmm. And your background in US, it's not very common that people from Estonia decide to make a decision to go and study in the US. Like, where did you get this first idea, and also the curiosity and the willingness to move there into a new
yeah,
country?
I really wanted to study business. I was interested in business. I was interested in investing, and then and then at that time Estonia actually wasn't part of the EU, so going to schools in EU and UK was much harder.
Mm-hmm.
It was easier to go to the US. So I went and applied and got into Wharton and had absolutely amazing 4 years there. Actually 3.5. I graduated. Managed to somehow graduate 6 months early and went and traveled the world, which was one of the best decisions at that time. And but yeah, the Wharton network and the business network is really, really valuable still for me today. Yeah.
Listening to your previous podcasts, you spent 10 years in US, worked in a PE firm, did investment banking. I'm pretty sure it was very different of what your friends and future colleagues saw in Estonia. So if you can maybe sum up this period in your life, seeing this intense world of finance.
It was a very intense world. It did give you a lot. And I was in New York for 5 years in the end, I think.
Mm-hmm.
And then I sort of came to like an interesting decision point where I had then at that point been, I'd say 10 years in the US, and really started to realize that if you're working these hours and you're like really giving everything, you really need to be connected to the mission. And 10 years in the US, I probably started losing that a little bit and started to feel that maybe I wanted to do it back in Europe. So that's why I went into my MBA in Europe, still thinking whether I should go back to the US or stay in Europe. And so that's sort of the journey of coming back. And I think it's just like, if you look at the US market, we talk about it, how it's a much bigger market and an efficient market, but at the same time, there's also enormous amount of competition. So I really sort of what really resonated me as I started looking into deeper and deeper into the region that we invest, that you were sort of able to find an edge. And I think I could connect it back to where I was from, and kind of combining those things, it's like it's really not difficult for me to get up in the morning, if that makes sense. Yeah, but I think the 10 years, I still go back to New York to see my friends and sort of the network there, and I speak to fund managers there all the time. And in many ways, the US private equity industry is ahead of Europe in many things. You know, this morning I was speaking to an investor about AI and software, and just like the natural clashes that are happening in the US so much more than they are in Europe. So I think all these networks, I try to give back as much as I can, and also really sort of make use of them.
Could you give us an overview of Livonia Partners today? What exactly you're doing? It's fun to share a little bit of what exactly are you doing today, and then we go back like on the day one.
Yeah, we are. Livonia is probably today, at this present moment, the only pan-Baltic dedicated sort of like middle market private equity manager. We've been around a bit more than 10 years. We like to think we're generalists, but we will feel really, really comfortable in sort of technology, business services, and industrial sectors. Tend to look at businesses between 1 to 3 million at EBITDA at entry, 1 to 3, 1 to 5, and then trying to get them to about 10 by the time we exit. And our investors we have local investors from the Baltic region. We have investors from the other side of Europe. We have investors from Scandinavia. So really sort of like a diverse investor set. And a flexible mandate from them to do both minority and majority deals. Yep.
And going back to the day one, like the initial idea, what about the team in the beginning? What about the fundraising process? Because it's extremely hard. Doesn't really matter where exactly are you doing this, but it's extremely hard.
It is hard. I agree. I remember during my fundraise, some people who had done it had told me that, fundraising, this is the easy part, and it's the investing that's hard. And while I was fundraising as a first-time manager, and it took us 3 years, I really didn't like those comments. But looking back, they were absolutely right. Yeah, you at the time of a fundraise, you do think that it's the hardest thing. But somehow you get there and you become like a viable entity, and your partnership sort of works. But looking back, like really, really choosing the right things to back and right things to invest into is the harder part of the job.
And the first fund, how much did you raise? And you said
I think it was around 85 million. Yeah.
So for US people, it's around 100 million US.
Correct. Yep.
Okay. Something you said on your previous podcast was when you started doing the deals from the fund one, you oftentimes had to partner with other Estonian entrepreneurs to get the deals over the line. What was the reason behind that?
Because our fund was a little bit too small. I think it's very, very important that you have sort of the funded strategy that also matches the market. And I would say at that point, given the opportunities we saw, we were probably a bit too small. So we had to do these. We had to do these. Let the entrepreneurs come stay in for more share than they wanted to, or we needed to bring some other people in, or we needed to at least have the voting shares, not the economic shares. So the early years certainly took a lot of structuring, and that was behind the. Really trying to making sure that if we really believed in the set of companies that we were buying, the sizes they were, and there's a big thing about size that in some ways there's a lot of risk in buying something that has 500,000 EBITDA versus 2 million EBITDA, because a 2 million EBITDA company, you can already hire like a good quality management and sales team and so forth. You can have a lot of growth for a 500,000 EBITDA company, but also comes with some fragility.
One thing you brought out was that your biggest competitor is the owner who doesn't want to sell their business. a good
Indeed.
business. Okay, that's one thing.
Yep.
But when it comes to the thesis on the first fund, like what type of companies you wanted to acquire and invest in, because now it's about business services, technology, more towards technology. Was it different on fund one?
Yeah, I think we really fully started as generalists, and I would say that there was 4 very capable partners that came together to invest. Probably didn't spend enough time discussing sort of like joint principles and why we are jointly doing things, and then there's reasons how out of the 4 now there's 2 left and the team sort of has moved on. It was in the early days, so that mostly everybody was kind of pursuing their own investment convictions in some ways. And I learned a lot in the early days, from the first fund, that there's a lot to be said for people really constantly trying to go for multiple arbitrage, for example. It's something that I've learned that it's actually like really, really unpredictable. You still have to do the work, you still have to buy things fairly, but sort of counting on multiple arbitrage has never been the MO for Livonia. We tried going for it sometimes, but the gap is always smaller. It's not Baltics for, let's say, Western European buyers is not a natural place where they wake up and say, let's go buy something in the Baltics. That's just not a sort of like not a discussion point for them. So really, really have to make sure that you are sort of creating companies that are really, really solving some sort of big problem, or providing like an excellent service, that you're causing someone a headache, such a big headache that you almost have to go for it. They have to, you give them a good reason to buy you, basically. I think the second learning from the Livonia early days versus like fund 1 to fund 2 is that I was in New York. I was working in a fund quite a large fund called Irving Place Capital, and I was really working on like industrial and like packaging companies and things like that, and that was my expertise. And I really, looking back, I certainly overestimated what that expertise mattered. Mm-hmm. That I've since gone to basically learn that you sort of constantly have to push yourself to learn about new business models and new industries, and even within like the industrial industry, for example, there's 100 subsects for what people are going for in terms of automation, or Livonia is Livonia is not the type of fund that it will go and try to find the cheapest priced manufacturing business in Estonia. That's not the we're going for something, and we're happy to pay up for it, but a company that is really growing across Europe and either going through a generation change, or they just growth requires capital. They don't want to do all the capital investments on their own, and that's kind of Livonia will come to play. Yeah.
Let's talk a little bit about sourcing. How do you find the deals? Which type of sources you're using? Is it brokers? Is your team doing the cold outreach events? What has worked well, and what exactly are you doing today to find those great companies to invest in?
I think sourcing, I truly believe, is Livonia's secret sauce. Like if you ask us to pinpoint to one thing that maybe makes us successful, it's sourcing. By how much we do it, how do we do it? We do all the things that you just described. We monitor all these companies. We go to the conferences. We organize events. We do all that. But on top of it, we really, really live on top of each other to kind of constantly source. We have these CRMs, but the CRMs are sort of like ways for us to almost like police each other, that have you checked in with that company, or can you go and get an update from that, and enough time has passed, and should we push a little bit harder there? And so it's very, the team works really, really intensely together on that. We call it we're going through the exercise actually right now. We call it the kill list, so that everybody has to come with like 8 to 10 companies, and you have to be able to kill one. You have to be able to get to like an investment. So you put down the 10 names. You have to get in touch with them. You have to get an answer, and then exactly really push it so far that that it's actually an sort of like an investable case. Yeah, I think I really truly believe good sourcing is a cure for a lot of things. But oftentimes we find ourselves in a position that maybe something like a deal there's something that we don't like about the deal, that we are maybe done like a lot of due diligence on already, or that we really discover that we don't like something. The best cure for that is having an alternative, honestly. Sort of it gives us like a very unemotional way of doing the job, and I think we're lucky for that.
Now, if you look at the map, there is Baltics. We have Estonia, we have Latvia, we have Lithuania. It's a reasonably small market. What is your answer to people like folks in the US listening, saying it's such a small market? Do you have enough great companies there? What is your answer?
The answer is that there's not enough funds here. That's the answer. Yeah, that's sort of our niche here. Yeah, and that's the reason I honestly made the switch, because I saw the number of companies, and I saw the funds per there's a metric like PE capital per GDP, and it's like it's multiples what it is in other parts of Europe, and that's sort of where I saw the opportunity, and I did long homework, and then it basically started raising the capital, and eventually started investing in 2015.
So the change in terms of doing it here instead of and not doing that in US.
Change.
I mean, like, you looking at the opportunity in here, that there are so many companies in here, you could have done it in US as well. I mean, the
no, for sure. Yeah, no, for sure. And I have had friends who started with smaller funds and gone to bigger funds and specializations, and going through some of the same things about team and where they focus, and I think it's and really finding that niche or some sort of a edge to me is important, and it's okay if it changes. Like if you ask a fund like Fund 1 to Fund 2, we invest in a completely different set of companies, almost completely different. Based on industries, yes, you can say that. Fund 3, it's also likely going to be the case that it's going to look a little bit different than Fund 2. And it's because the economies are changing a little bit. Estonia, Estonia, Latvia, Lithuania, it's quite a small region. So a lot of these businesses, to get bigger and to grow, they have to go outside the region right away. And those are the types of opportunities kind of Livonia likes to find. Yeah.
Now, 10 years in, how have the multiples changed over the time?
Today, this moment, I probably would call it the buyer's market. In 2024, we were able to sell and really return money to investors, and we were able to sell good companies. 2025, less. On both of these years, we've invested a lot of capital. It's been our conviction that this is the time to do deals. Livonia doesn't have the handwriting of somebody that, as I said before, like looking for the cheapest asset, or really trying to beat down the price. When we see that somebody's asking for a fair value and it's justified, we kind of pay for it. Yeah, we bought businesses for 5-6 times EBITDA, but we also bought businesses for 10-11 times EBITDA. So it's a mix of that, and really trying to understand that certain multiples for certain businesses just are like that.
And when you're looking at the portfolio now and the deals you've done, what's the ratio between minority investment, majority investment, and how has been the performance? Can you compare those two?
Mostly majority, but the performance is inconclusive in a way that you can't say that minority or majority has outperformed. We have made money on both, and we would like to. We asked for this from our investors in Fund 1. It worked. We asked for this in our investors in Fund 2. it worked, and we're going to be asking for it going forward as well. Because sometimes we have companies in the portfolio that we do these minority investments, and there's like clear reasons why the owners don't want to give up control, and but they're still amazing companies, and would like to be there for those companies as well.
Let's talk a little bit about the post-acquisition and your management style, and what do you expect post-acquisition? Do you sometimes change the management, or what are the obvious things you maybe change in the first 90 to 120 days?
I would say that but we don't necessarily go in thinking we have to change a lot. I would say that's a starting point. I think if you're going in and thinking you need to change the CEO, then you're kind of solving someone else's problem. If the CEO or management needs to be changed, we typically ask for sellers to do it before the deal, and that's usually something you can find pretty good agreement. And then you also want the CEO to be in place, and we like buying things that are sort of working. Having said that, we work exclusively with SMEs, so small companies, and with small companies, there's always something you can do. The work we do with our management teams is really intense. I can say it like that. It's intense. We work really, really close to our companies. It's almost sometimes the management team's a little bit taken back, like how close we work with them, that we are not just tracking them on a monthly basis, but we're on a weekly basis we're calling, or we're focused on certain things. And we try to probably set certain we set reporting and things like that, obviously, but we set certain OKRs and within the first 100 days, to making sure everybody understands what sort of how we work and how we look at everything in the same way together. And then you get into things that in SMEs are very common, that you're working with constantly upgrading your team, maybe exploring new markets together with the teams, looking at M&A intensely together. All these sort of smaller things that we kind of create as joint products with the team. Yeah.
Today's sponsor, CapitalBad. This episode with Kaido is all about building an enduring private equity firm, backing founder-led businesses, protecting downside, and compounding capital in smaller, relationship-driven markets. That's exactly where CapitalBad fits in. CapitalBad gives accredited investors access to private, operator, and sponsor-led acquisitions of real, cash-flowing small and mid-sized businesses, the kind of durable companies firms like Livonia partner with and scale. These aren't financial engineering plays. They are structured with aligned incentives, thoughtful downside protection, and long-term ownership in mind. If you're an LP, family office, or serious accredited investor looking to back disciplined operators building real businesses, CapitalBad is worth a look. You can learn more at capitalbad.com. I'll also put the link in show notes. That's capitalbad.com. And now back to the show with Kaido. What comes to mind if I say a word incentives? Based on your experience, based on the deals you've done, exits? Yeah, when I say a word, incentives.
Yeah, I mean, if you're talking about management incentives, it's kind of funny. If you we have our core partners in the Money Fund 2. We have 4 partners, and I would say that for each of the partners, how they set management incentives is different. Yeah, and for me, I do believe in options, and I believe in normal vesting schedules and things like that, and giving them to management early and really having them buy in. And I don't really make them. I don't make them pay for it even. But it just everybody has a little bit. Everybody has a little bit different setups, and also a little bit inconclusive what exactly has worked or what exactly hasn't worked. I can tell you that, for some companies, you think you have an amazing incentive system. It doesn't necessarily. It makes the people maybe focused, but it maybe doesn't save a struggling company, and I don't believe in annual bonuses, for example, that sort of like really, really big bonuses based on 1 year's results, because we are private equity. We are, holding our companies 4, 5, 6 years. So it's very, very important that people understand that, yes, we're in a time schedule, but you can still go and try things and make mistakes and invest capital and try things with people. Because you have to give them that sort of like a long-term, how do I say, a long-term operating mindset. Yeah.
You shared me some of the companies you've built over the years. Maybe we can go through some of them and trying to understand your you and your team idea when it comes to those portfolio companies. Is it oftentimes through an M&A or organic, or what are the things you're doing there? Because let's take this traditional business case, Thermory, because you bought it, you grew it, and you've done an exit. So maybe we can talk about this, what type of company it was and what did you do to, it's a 5x growth pretty much in revenue.
Yeah, Thermory was actually Livonia's first investment. At that time, quite a large investment. They say about fund and fund business, the first, last, and biggest investment go wrong. So that was our first and biggest, and it actually, we were just lucky that it kind of worked out. It's a manufacturing business initially that was making sauna materials. It's, we can call it niche within the niche, but like growing 10% a year and very profitable and focused on the Nordic market. So yeah, we paid a fair price for it, and then very, very quickly started looking where we could take the business. I would say back then we were sort of bought it and figured it out, versus today we would have blueprints before we invest. But at that time we realized really, really quickly that the really like an adjacent industry to that was thermowood, which is something that you treat the wood and you use it for decking or cladding, and it basically extends the life, it really multiplies the life of wood, and it's used in construction all over. And it's like that was like a 15 to 20% growing market globally. So we went and we tried to actually acquire or merge with one of our biggest competitors in Estonia called Thermory. We initially bought a business called Haaser. So Thermory is the business that we eventually merged into. But the first time we tried to merge, they didn't take us seriously. It was really, really early. We didn't take them seriously. It was like really, really difficult to merge because two companies were really kind of like competitors. So we went and bought the business in Finland. In Thermowood, they probably saw this as a sort of like a mini threat. So that helped us get into sort of the merger discussions again. Then we agreed. And finally we're able to buy another business with 3 manufacturing facilities in Finland. That was sort of like a manufacturing of painted wooden products. And we really, really pushed that niche all over Europe. And I think the US at that point was like a 20% of the entire business, and really, really growing. And we had an excellent team there. And and then it came sort of COVID hit. We sold the business, I would say, in the first months of COVID, which initially you saw that there was like a bit of weakness coming in. And but we had a motivated buyer. We were not forced to sell, but we had a motivated buyer who I would say gave us a fair price. And then what do you think had happened to these like stay-at-home products during COVID? Absolutely boomed. So earnings, I think, doubled the next year. That doubled, and thankfully the next year, like the following year, normalized, and we actually structured an earnout that paid us a bit more 2 years out, but it wasn't just like the craziest boom year. But yeah, that ended up being a good investment for us.
What is your take when it comes to those businesses? You buy them, you start making improvements. You said you're very intense, but at the same time, you mentioned that you're leaving some meat for the next buyer as well. Like, what is your take there? Like, how tired is the team after you sell the business to the next PE firm or strategic card?
Actually, I would say that that's actually a really, really common mistakes for some private equity builders, that so often we see a business that is like 90% utilization. And the investment deck is basically telling us that, yeah, you can go in, all you have to do is invest 8 to 15 million. And then you can get all these customers and beautiful revenue, and everything will be just amazing. We see so much of that, and maybe even in some moments we have like not realized that you have to leave something for the next buyer. And if you want the fair price, you really have like a good price. You really have to leave an impression that the next buyer can continue to really build it. And I do truly believe that's a common mistake of anyone selling a business, that sort of demonstrating that the growth is sustainable, and you haven't sort of it's okay for you to squeeze everything, but then you have to make sure that everything is ready for the next buyer, if that makes sense.
And now I'm looking at another company here. It's a company called Scoro. It's a CRM. So how diversified is your portfolio, and what is your take? Like, you're going and making one day like an investment in a wood industry, then some time goes by and you back a company which has raised VC money. We can see this company has grown a lot at entry. It was 2.8 million in top line, and today it's 16.2 million.
I think even higher today. Yeah, Skoda probably wasn't a typical investment for us that we would make it today. Even at that time was unprofitable. But Estonian, particularly Estonian, I would say growth and venture capital ecosystem was empty at that point. Now it's not. It's probably much easier to raise money in VC and growth stage. But we like the company. We like the founder. It served as such an amazing learning for everything else we have touched in technology and business services. We could literally take blueprints from how do we track the business from Skoro and apply it to other businesses. That's such a common thing that we do these days. Yeah, the two companies you just mentioned are exactly good examples on specialization. We kind of started with, Skoro is in technology, but in early stages where we learned a lot of lessons, and then, we learned so much on Thermory, but, not everything that you buy, you're able to go and make all these acquisitions. Actually really, really rare. I would say that if you're able to do it in 2-3 deals out of a 8, 9, 10 investment fund, you are lucky. Because we've had many examples. We have a company in Fund 2 that we already sold called Stebi, small investment, but we thought that, okay, we'll go and we'll just invest more and consolidate the market. Capital in itself is not a differentiator. We went to the market and we kind of openly said we have capital to deploy, who wants to sell, blah, 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 and then very quickly realized that everybody had already, in the market, that already the best things have already been bought. And just because you had money didn't mean anything. So we were not able to consolidate or buy anything for that company, but we're lucky enough to exit.
Those Stebi guys, they came to you with the thesis of?
Stebi was an MBO. Stebi was an MBO. It happened sort of very quickly. The deal was almost structured 50-50. I think we had one extra vote, and company that was, we buy things that typically are looking towards Europe, but not every business we can do that. So Stebi was a pan-Baltic background and really, really strong in Estonia, and they just had looking back, they really had an exceptional management team, exceptional CFO, exceptional CEO, and exceptional sort of like head of growth who we rely on for some other of our businesses too.
Now, you said before that there are enough good companies here, but not enough buyers like funds. But on your side, when you're buying those businesses, growing those businesses, is it enough buyers for those companies you're building? Or from which, you said you hold companies for sometimes 4, sometimes 6 years.
Yep.
From which moment you start looking for buyers already?
Very good question. I would say that this has been a key learning for us as well. And nowadays we call it exitability. People at Livonia who are making an investment have to have a really, really good idea which other funds or which other strategics are growing and maybe consolidating in the space. They have to have examples. They have to have examples that are like not completely on the other side of Europe. They have to be relatively close. Ideally, maybe somebody has consolidated in the region. Yeah, we basically nowadays, if it's a beautifully growing, let's say, industrial business in the Baltics, but we don't see that anyone is consolidating or anyone is paying attention to this product in the other side of the world. More likely than not, we're not making an investment. Like exitability is a big thing for us, and I think generally European and maybe even big part of US private equity is a little bit ill right now because the key 3-letter abbreviation is DPI, being actually able to return money to your investors. Yeah, it's a big focus and a big learning. I think we've been lucky for settling things off in our fund one. We only have 2 companies left. You can even say almost just 1 left, 1 exit pending, and I feel very good about being able to sell companies that we have invested in fund 2. It's a crucial thing. It really is a crucial thing. Yeah, we now do a lot of work and basically pay a lot of attention to that.
What about some of the deals which haven't gone that well? Why it happened?
I would say that we probably have made, if you talk about mistakes and talk about the types of mistakes, we probably have made most of them. I'm honest here. Yeah, for the things that didn't work, what contributed to the reasons it didn't work? Leverage. So yeah, the average leverage in fund 1, and we can't operate truly without leverage. But our leverage right now is, I would say 2.5 to 3. That's kind of where we aim. We have some companies that have absolutely no leverage, and we're just entirely dependent on growth. The average leverage in fund 1 to fund 2 is, I would say, exactly like 30-40% lower. So leverage was a big part. How do you structure deals? And then other maybe key learnings is that you really have to be convinced on like industry. And what I mean by that is both size and growth. You can go after a big market, but it's beautiful to have a big market, but if you have big competitors there who are just have bigger budgets and much more capable, even if you had good year, competing against them, but you lose like a top sales guy, you kind of like, it's a problem. So we have definitely overestimated things about the market and our ability to compete. And sometimes exactly if it's like, really good growth and quite a good market, then you seem to have good control of the market. You simply run out of, you can never get to, it's easier to go from 30% to 50% and like from a market share to, let's say, 80 to 90. Like you'll never have the entire market. That's just people don't operate like that. Yeah. Market structures typically follow that, customers will want alternatives and, maybe don't take your product or service for their own different types of reasons. So, yeah, we definitely learned a lot from that.
What is your take when it comes to the size of the fund? Definitely, you having building this track record in here. Some fund 2 is doing maybe better than fund 1. In the future, probably raising a fund 3. What is your take when it comes to on this Baltic market here, that there is a ceiling from which it's not a good idea to maybe raise more capital because it's hard to generate great returns? Is there a gap? Or
no, there definitely is a gap. Like we have this beautiful competitor in Lithuania called Invalda, and they just raised a really big fund, 400 million fund. But with that size fund, there's really like you can't invest here. There's not enough targets for you. So we believe that the right size is anywhere between probably 150 to maximum 250. But like, honestly, that the region should have many funds within that size range, because then you have enough capital to find these small profitable companies, to amplify them and do M&A for them. That's an ideal size, but it certainly has sort of like a cap. Yeah.
Okay, a very personal question here, because you're you're having this awesome family, 2 kids, third is coming. Your wife manages a 1 billion VC fund in London. So how are the conversations at home, and what are the discussions at the dinner table? Because it's same, but it's very different. what you're doing, and it's not very common that you have you have a family where you manage a PE fund and she's managing a VC fund.
Yes, I met my wife Ophelia in business school and at INSEAD. Yeah, I think initially neither of us were like going for the fund idea or had it, and then I started my fund, and then she sort of, I think she looked and she saw that she could do it, and obviously has done exceptionally well, being a Series A investor in Europe. Yeah, I think, around family, we have certain sort of like boundaries where what we allowed to do in terms of being in and out of the country at the same time, and how much time we sort of like have to give to the children. But dinner table, it's sort of interesting that I can't do her job and she can't do mine. And what we probably don't discuss, we don't discuss companies exactly because of that. The funny example is that she told me not to invest in Wharton, 50 million valuation. Company now is worth what, 3, 4, 5 billion, and but it's just a fun example. Honestly, looking back, if we invested, Livonia would probably be in much bigger trouble these days, because we would be skewed on our investment strategy and trying to find our kind of like feet and consistency. But what we do discuss a lot, where there's a lot of similarities, is team. So like, how do you create the best teams? How do you get performance? How do you manage team dynamics? How do you recognize that somebody who is a B player will never be an A player? We discuss a lot on that, and I think I learned a lot from her, and she's an exceptionally sort of curious person, and that's something that I have really learned from her.
But you mentioned that you wouldn't be able to do her job, she wouldn't be able to do your job. What do you mean and why?
Because it's a different type of risk we're taking. Yeah, I'm almost investing without the loss ratio. I have to allow a loss ratio to be able to make sure that I'm taking enough, or the fund is taking enough risk. But she's investing with an exceptional loss ratio. That like 80% of her companies don't work out, and yet she's been able to, and with that strategy, able to create many unicorns in Europe. I would say that I think I told you before that before I became a private equity investor, I tried it, tried being like a trader, and very, very quickly realized that I'm like somehow really, really uncomfortable with like short-term decisions. To me, I was okay to do a lot of work, make a decision, and then be locked in that decision for years. And that's what private equity investing is. And venture and the venture game is obviously very, very different. You are really just with everything that you invest in, you are shooting for the stars. And actually quite quickly, within the first year and a half, if the company is going to be something. Yeah, it's nearly impossible for somehow there being like a delayed reaction. You'll know quite quickly.
Mm-hmm. Yeah. One more quick pause to talk about today's sponsor, Spacebar Studios. If you're listening to this episode with Kaido and you're thinking, I need better deal flow, better talent flow, and a way to stay top of mind with buyers, sellers, and capital partners, the answer is a newsletter. Spacebar Studios helps operators, business buyers, independent sponsors, and investors launch high-quality newsletters that actually compound. Not vanity followers, not random impressions, but real subscribers inside your list, the exact people you want to do business with. They'll even guarantee a minimum of 10,000 targeted subscribers within your niche in the first 90 days. No long-term lockups, and after launch, it's month to month. And they'll honor your first 30 days free, so you can start risk-free. So if you're serious about building a compounding asset alongside your operating company, go and build a list with Spacebar Studios. I'll put the link in the show notes. That's spacebarstudios.co. And now back to the show. You're 10 years in, looking back, the decision that you decide to choose a smaller market where some of your friends and colleagues in US try to do that in the US. You decided to compete with, again, not too much competition in here. What is your take, maybe, if you're looking back, starting today, and what I'm referencing is to starting with extremely niche focus in a small market compared to going to something huge and with a lot
Like why I made the decision, or how did I make the decision?
Yeah, if you were starting today, like knowing what you know now, you've seen a lot of deals, you've raised capital in different environments.
Advice to new teams.
New teams, someone coming out of school, someone working in a PE firm, maybe wanting to make the jump.
Yeah, what really resonated with me is Steven Schwarzman has this book, What It Takes, and one of the things he talks about there is that you always have more time than you think. It's like deal fever and things like that. They're real things. You know, you go through and you find the company and you feel like it's sort of like eating you, and everything that you're doing is, you know, trying to make sure this is a good company and trying to like maybe do things a little bit too fast. Looking back, I definitely do feel that like taking your time on certain things, and maybe it's a little bit of a luxury of Baltic market exactly that has like very limited competition, that we have had that time, and whenever we have kind of taken our time, it really has paid dividends. It really, like, more time with management. You're not sure about something, go and speak to somebody else, you know, some other people in the team. So I think that's one thing. I would say Livonia was also created with 4 very capable founders. You know, you'd look at all these founders individually and be like, wow, he or she is very, very capable. And but as I said before, probably didn't spend enough time in the beginning on real alignment. Like, it was on a piece of paper, we were all we had unanimous voting, and we had everybody can go and basically do deals, and we were supporting each other. But the truth is that we spent a lot of time doing deals individually rather than collectively. Like, maybe 2 people work together on something, but there's a lot less teamwork. And I think a good cure for that is to really take the time with the team you're teaming with, the team you're teaming up with, because this is a long-term business, and investors want stability. Out of the 4 people who created Livonia, 2 are here today. I don't think the people at Livonia today like going through that change. Our investors certainly didn't like going through the team change. Yeah, I think taking the time and knowing that you actually have time is quite an important thing to do in the beginning. Yeah.
Would you maybe add some specific takes on this?
I think an example is that we spent sometimes the colossal amount of time analyzing like a company. We got let's say we got an information on the company, and we would, I don't know, spend weeks debating it. Right? We spend weeks debating it before anybody had even gone to, like, I don't know, explore what the seller's expectations were. So and we would, like, obviously, like, with this, like, beating each other up, all this analysis, and then realizing there wasn't even a deal, and then basically huge wasted time, and like maybe wasted emotions and all these things. So what we certainly have changed in Fund 2 is that we have pretty clear parameters from what we are looking for in companies. Like, everybody at Livonia understands that, and everybody has a lot of responsibility on an individual level. And then we basically trust people to go out and do all of the initial work, even after price discovery, submitting an LOI. Once you're getting to like an LOI and sort of a price agreement, it's only then when the rest of the team really comes in and basically starts paying attention. So we give a lot of that early responsibility to the team these days. Yeah, which I think is a better way to operate. And it's much faster, and because LOI really doesn't mean a deal. LOI is basically letter of intent. It's gives you an exclusivity period. You don't necessarily have to go and start spending money yet, but it's basically a commitment from both sides to go and make a significant information exchange.
One more question. I wanted to ask this in the beginning. I forgot. When your take on team, like you've said that you always want to keep it small. Why is it like this? Have you seen like larger deals things didn't work out so well, or what was the reason?
Another good question. It's truly based on just like a conviction. Some of the best, like venture funds in the world are like super, super tiny. Or at least like the decision maker circle is like really, really tiny. So it's something that I just simply happen to believe. There's definitely work for Livonia is about 10 people today. There's definitely work for 20. There really is work for 20. We like to give people a wide set of responsibilities. We'd like to hire people with the promise that you are here only because we saw partnership potential in you, even when you were an analyst, joining as an analyst. So people come and, they go to board meetings right away. They go to, new investee meetings right away. So that's, it's just a belief. And I think looking what operating like this has done to us for since the beginning, it's amazing. I mean, we had the first 2 employees that joined Livonia as analysts are partners today.
Okay.
So that I think that's a good signal for anyone who sort of considers joining Livonia. That's kind of the path.
Okay. So 2 quick fire questions I always ask at the end is what is the best investment advice you've ever received? Number 1, and number 2 is what is the best book?
I think best advice is that I have what I noticed a lot with SMEs and these businesses that are growing up and changing a lot is that a lot of sort of emphasis sometimes is kind of like placed on brand and reputation, and I have a view that it's sort of overemphasized. Like I'll give you a lot of people. They say, for example, that they can't do something because it's bad reputation, or like undercutting a price to your customer just to win the customer, like significantly going against your competitor, or like, for example, taking a top salesman from a competitor. Somehow it's like, oh, we can't do that because like we have this reputation and we shouldn't play with the reputation. Everything in SME space, you are tiny. Unless you have hundreds of millions of revenue, maybe you're starting to get to something called reputation or brand. If not, you should just play quite aggressive in business. And particularly, we particularly see it in the SME space because these companies, they come from nothing to a place when they establish and have something, but oftentimes maybe feel that it's fragile, particularly when they have like customer concentration or depend on certain key people. We really, really push them to go faster and push them to go and do these sort of like aggressive and necessary things that I'm sure their competitors did, years back. So I think that's something that I always remind myself, and I remind some of the founders that we work with. Yeah.
And the book, last one, if you ever have time to, are you an avid reader? Do you read a lot?
I read, more in my 40s than certainly in my early 30s. I just finished the book, The Score Takes Care of Itself, which is it's like an American football coaching book, which talks about, again, building exceptional teams. I read 3 categories of books typically. It's like investing books, and then leadership books on how to build like really, really amazing teams. And then, about black holes. So just to go really, your brain sometimes needs a break. So the recent really, really good book I read was What It Takes by Bill Walsh.
Okay, perfect. Kaido, thanks a lot for doing this. I'm very happy that we got this thing done, and best of luck with everything, and let's do it again maybe in few years to see how the current deals have been going.
Thank you again for having me.
I hope you enjoyed this episode of Buyers and Builders. Please remember to subscribe wherever you're listening and leave a review. It really helps the show reach more buyers and operators. And if you already haven't, go back and listen to some of the other episodes of Buyers and Builders. This podcast is built for people who buy, build, and hold great businesses long term. Every guest you hear on this show has real, hard-won experience acquiring and operating companies, and the goal is, again, very simple: to give you ideas you can actually use in your own journey.